Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have Adrian Day of Adrian Day Asset Management and the portfolio manager of Peter Schiff's Euro Pacific Gold Fund. Adrian is going to give us his take on the economy, precious metals, commodities, and the questions you submitted. Adrian, thank you for coming back on the show.
Well, thank you very much for having me, Steve.
Yes, pleasure's all on this side of the table, sir. I got to say, a lot of the presentations you've been doing in the rural classroom have been just top notch, really good. I want to personally thank you for that.
Well, thank you very much. I appreciate that. I'm debating what to do for my next one, which is the day before Thanksgiving, because I would have thought most people have something better to do the day before Thanksgiving.
I don't think so. There's no place we'd rather be. So your last one you did on Anglo Gold and the Silicon Merlin deposit and what's going on with Orogen and Altius there. That one went over 2 hours. I remember we realized that apparently there's a time limit in the classroom of how long you can talk, and we hit it. So that was pretty cool.
Well, that's good.
Yeah. Any updates on Altius or Orogen since then? That was 3 weeks ago.
Yeah. Well, I mean, Altius has had a couple of updates just on their earnings and on Prospect Generator portfolio. You know, they always do a separate update on that. The Prospect Generator portfolio is doing very well. I've often sort of joked to Chad and to Brian, please don't let Chad become a portfolio manager because he'll be too much competition. He's doing very well there. What they've done, obviously Orogen has really helped the portfolio, but they've also shrunk the portfolio. They're trying to sort of dispose of ones that they think are marginal or don't really have any particular high prospectivity. Doesn't mean they're bad companies, just they don't really fit with what Altius is maybe looking for. So that's positive. On their earnings, on their royalty earnings, it was down from last quarter and from a year ago, but that was kind of expected. So I would say that their earnings were sort of in line with what was expected. And as always, you get, let's see, the renewables did very well, was strong. The phosphate was low. Iron ore was more or less in line. So, you know, and that just shows you the benefit of having a diversified portfolio, which is what they have. There's always going to be some that underperform, but we hope there's going to be some that outperform. So, you know, that was sort of more or less as expected. Nothing particularly outrageous there. But there's been no update on Silicon. And as we talked about 3 weeks ago, it's really quite a puzzle why this arbitration decision is taking a long time. Altius is being a little closed mouth on it. Paddy at Orogen, sorry, Paddy Nickel at Orogen and I have, you know, discussed it at length, kind of sitting in the sunshine with a drink, sort of what could this mean? But, you know, he's as puzzled as I am. So we've speculated on what it could mean, but I'm not really sure that that's worth talking about because it's pure speculation. It's just taking a long time. We can certainly say that.
Okay. So it still could be 3 weeks out, or it could be 3 months out, or it could be.
It could be while we're conducting this interview.
Yeah.
But Anglo will have another update at the end of the year. And I'm thinking that they really need to say something. They probably will say something on those Western extension drills that they've done. They've got a lot of drilling out there, which is outside the main deposit, but within Orogen and Altius's royalty. And you don't do that number of drill holes unless you're getting something. 6 months ago, after the first or second hole, Alberto Calderon, the CEO of Anglo, had said they were getting excited. I think exciting was the word he used, exciting results. But you don't keep on drilling like 28 drills now. You don't keep on doing that unless you're getting results. So let's hope they put a number out, or at least flesh it out a little bit at their year-end update. And that will be positive, because it shows that, as we all suspect, but it'll demonstrate that this deposit has a lot of room to grow, a lot of room to grow.
Yeah, yeah.
That was a long answer to say nothing, wasn't it?
No, that was good. Little golden nuggets here. Yeah. If you guys want to check out the full presentation, go to the Rule Classroom, and it'll be there. Well worth it. I'll put a link down in the pinned comment below. Okay. Thank you, Adrian. A little update there. Let's start out like we always do. And what is your macro view of the world economy and financial markets today?
Gosh, that's a huge question. Obviously there's too much debt in most of the developed world, and not only the developed world, but the US, Japan, Britain, Europe. We're just swimming in debt. And the debt to GDP ratios are, really quite concerning for many of those economies. So as you know, many of the central banks around the world, Japan is the exception, as it has been, for 40 years. But other than Japan, most of the central banks around the world are lowering interest rates. The Fed cut interest rates for the first cut in the cycle last month. And my sense, my sense is that, as much as they're doing that because the unemployment ticked up, the main reason they're doing that is frankly because of the debt in the economy, and that probably is true for most of the countries in the world. And it's not just the debt in the economy, but of course it's also the central governments, the federal government's debt, and the massive interest rate service payments, which are really just totally unsustainable. It's now the largest single segment in the economy, depending on how you count different segments, but it's the largest single outlay is just servicing debt. That's a very, very dangerous place to be. So I think we're going to continue to see interest rate cuts around the world, and that's of course before the central banks have actually conquered inflation. They brought it down from the post-COVID highs, but that would have come down anyway, frankly, the excessive highs after COVID, because that was not monetary inflation as much as, supply issues and so on. But the monetary inflation remains, and they haven't conquered that. And if you look at the US, where whatever indicator you care to use, but if you use the core PCE, which is the Fed's own preferred index, that's for people who don't eat and don't heat their homes. But that's come down from 9 down to 2.7, 2.8. But that number is still well above what it was pre-COVID. It's also significantly above their own target. So the point I'm making is that they're starting to cut rates before they've conquered inflation. And that is a very, very dangerous place to be in, because that's going to lead to, stagflation. I'm not talking about runaway inflation anytime soon. I'm not talking about an economic depression, but sluggish economic growth and stubborn inflation is stagflationary. And in a stagflation, developed market stocks and bonds do badly, and gold and other commodities do well. And that's the sort of framework that I have.
Okay. All right. So debt to GDP isn't looking good. Interest payments have become the largest payment, which is never a good sign. And you see more interest rate cuts coming. The CME tool sees the same thing. I'm going to share my screen here, and maybe I'm just showing my ignorance as a bond trader. Do you see any opportunities leading up here? This is the intermediate treasuries. Here's TLT. This is a common one.
Right.
Do you see any possible maybe a trade here, or am I just
Yeah, well, first of all, you said a trade.
yeah.
First of all, as an investment, I wouldn't dream of buying longer term treasuries,
Yeah.
and longer term would be 10 years and out. I certainly wouldn't be buying 30-year bonds as an investment. And I don't know I'm not sure if anyone's buying those as an investment. Shorter end, putting money into one month, 3 months, 6 months, even T-bills makes a lot of sense as a parking place for money, especially when the stock market is so overvalued, in my view, and vulnerable. When I say something's vulnerable, when an investment advisor, by the way, is a tangent, when we say that a market is overvalued and vulnerable, that doesn't mean we think it's going to collapse anytime soon. We're just looking at the amount of risk that's in the market, and I think there's a lot of risk. So when there's risk, when things are overvalued, putting your money, parking it in T-bills for 3 or 6 months and earning 5%, that's not a bad place to put it. I'm not a fixed income investor, so I typically do not try to buy longer term bonds for trades. It's just not something I have a good feel for, to be honest.
Okay. All right.
And listen, Steve, I'm sorry, I need to correct something. I think I said Altius and I said phosphate. I meant potash, of course.
Okay.
Potash. If I said phosphate, I meant potash.
I think you did, because it caused me a moment, and I'm like, oh, maybe I misheard. Okay.
Yeah. Okay.
Okay. Thank you for clearing that up. All righty. Okay. Recent news here. We'll take a couple off the list. Current situation with Mali and Barrick. What do you see with that?
Yeah. The problem, so as you know, several of the companies, B2 Gold would be one, Endeavor, I think, is another one, but several of the companies have already made final agreements with the Mali government. Mali is a military dictatorship. They're wanting to get more money out of foreign investors, foreign companies in the mining sector. Now, they did, when they announced this, earlier, they said they were grandfathering, and Barrick, because it's had a mine for a long period of time, would be grandfathered under the previous tax regime. But there seems to be some dispute, and about what their obligations under that previous. Barrick is saying that they've met their obligations under that old regime. Now they're renegotiating for a new contract. I think it's a negotiating ploy on the part of the government, to be honest. And Mark Bristow, the CEO of Barrick, has a good reputation for being able to, settle these disputes in, shall we call them, risky companies. But it's still not. There's still nothing finalized. I mean, Barrick put out a press release saying that they had agreed to talk or something, which I thought was a kind of stupid release to put out, frankly. It was a bit premature. They should put out a release when they've actually got an agreement, which they clearly don't have at the moment. And the government is asking for 400 million, I think. I mean, meaningful, or 500 even. I mean, meaningful money. So,
I didn't realize that's how much they were asking for.
Yeah. So, well, I'll have to check that. Sorry, but it's meaningful money, and so and Barrick denies. Barrick says they've met all their obligations.
So this is kind of a typical government trying to get a little bit more.
Yeah, absolutely, and we've seen a lot of that in West Africa, of course. In the I'll say this as a Brit. I'll say in the former French colonies, Mali, Burkina Faso, Niger, they've all got military governments, and they're all trying to get more money out of the sector. So, you know, it remain. I mean, I think they will reach a settlement. Barrick will probably wind up having to pay more. Yeah. It's not 500, it's 50, sorry.
Oh, okay.
Extra zero in there.
Okay.
But
All right. Okay, but this probably I got a lot of questions on, like, them nationalizing the mine, and
I
that's
don't think they're going to nationalize it. No. I mean,
they're
that
just
was,
trying to squeeze a little more juice out of the lemon.
yeah, the Canadian press had articles suggesting they wanted to nationalize. That was a misreading of what is he a president? I don't know. What the military dictator, president had
dictator.
said. It was a misreading, but it was also, I think, a negotiating stance on his part. No, they have no intention of nationalizing, and they've made that clear.
Okay.
In fact, Barrick requested and received a written letter, for what it's worth, a written letter saying we have no intention of nationalizing the mine.
Okay. All righty. That's about what we thought. Okay. Any updates on Equinox and their Greenstone mine? That's been a little slow going, not quite as on time as we thought as far as the ramp up. Do you have any insight into that?
Yeah, the ramp up is slow, but a ramp up on a large mine like this is often slow. So the ramp up itself doesn't particularly concern me. It's a great mine, obviously. Obviously. I think it is and will be a great mine. The slow ramp up itself doesn't overly concern me. I think what's hurting Equinox is just this. It seems like almost a steady stream of bad news. An extra equity raise that after we were told there wasn't going to be one, and then sorry, who was it who came out and sold their shares? It wasn't Equinox selling the shares, but after that.
Did that have to do with I-80?
No, it wasn't I-80. Was it? Sorry, I'm sorry, Steve. You're asking me a lot of detail about different companies.
Yeah, I should know this one too.
No. I'm sorry. I'll find out. But it was a company that owned shares in Equinox, but was selling their shares. A convertible. They had a convertible. They converted and said they wanted to sell the shares. Equinox helped them place the shares, and a lot of people in the market thought this was Equinox raising money again. It wasn't. They had one raise in October, or September last year, but we didn't know about. What I'm saying is there's just been kind of a series of, and then the delay on completion and the slow ramp up. It just seems to have made the market sentiment negative. Greenstone is going to be a great mine. That's not an issue. I think the concern is, what's happening in Los Filos, where they've made it, in Mexico, where they've made it very, very clear that they have to cut costs. They've got a mining plan for the future, which is a lower number of ounces for a larger, longer number of years. But the costs have to come down. The labor costs have to be reduced. They don't need, for the underground, they don't need so many workers. And they need an agreement from all of the local villages to say you're going to get a smaller piece of a bigger pie, but they want all of them to agree, because as you know, that mine has had blockades and labor problems for many years under the former owners as well, and a lot of it is conflict or jealousy, or however you want to put it, between the different groups, saying that we're not getting as much as they are and they're getting a bigger piece than we are. Equinox has tried to manage that very, very well. And they're having these meetings now, town hall meetings, trying to explain that the mine at present is not economic. The new plan is economic, but it means it's only economic if there's a smaller workforce and the cost support under control. So they have to get that agreement. They've stated publicly that they will suspend operations at the end of the year if they don't have an agreement. It's possible that it'll come to that, and that will hopefully, force the workers to realize, force the locals to realize, that they have to accept lower pay. So anyway, that one is I think also weighing on the stock price. Yeah.
Okay. All right. So we might see a little bit more weakness coming.
I think it'll
term.
be volatile and weak for the next several months, frankly.
Okay. Okay.
Yeah,
But
yeah.
long term, you see positive outlook for the Greenstone mine.
Definitely. Oh, no question about that. From a point of view of buying, I mean, for what it's worth, what we're doing, I mean, I would look to buy it, but only on, meaningful weakness, frankly.
Okay. Okay. Awesome. Let's see. Other current news. I'll share my screen here so we have a visual representation of it. And this is Newmont. So Newmont,
Yeah.
we had less. I didn't think they were terrible, but less than what everyone expected for earnings. So we had a pretty massive drop. What are your thoughts on Newmont right now in their recent earnings?
Yeah, no, you're right. They were not terrible results overall, but there were two things about it that were bad. One was the cost. The all-in sustaining cost went up by $200 an ounce, which is astonishing. And then the second thing is that they reduced their guidance for 2025. So signifying to the market that this wasn't just a one-off blip. And I think it's both of those combined that hurt the stock as much as it did. On the cost, it's a bit of a puzzle, frankly, because the major contributor, they said, the major blame for the higher costs went to the fact that Newmont uses a lot of contract mining. I'll have to tell you, Steve, I haven't owned Newmont for many years. It is not my favorite of the larger miners. And when I say not my favorite, that's an English understatement. It's not my favorite of the major miners, so I don't follow it as closely as I do some of the others. But when their costs went up by 11%, their all-in sustaining costs went up by 11%, and the contract labor is less than 50% of their overall workforce, there's something else going on. Because the numbers don't add up. Those are not the sort of wage rate increases we are seeing in the economy as a whole. So it does raise the question, well, what else went up? We know that their G&A went up, and their G&A went up significantly, both on the last quarter, but also if you look back a year, their G&A was up significantly. And of course, the merger with Newcrest was meant to, the synergies were meant to bring down G&A, the combined G&A. So you can't blame it on that. So that is disturbing. It also raises a question, frankly, as to why they're using so much contract labor. But that's a different issue. I think also, but the other part of it is concerning that they lowered their guidance. I'll also say this: when you compare valuation multiples of Newmont, even after this big drop, compare that with Agnico and Barrick, and Newmont is still more expensive on most metrics. They have more debt as well than the other two. I think what's happened, I think the reason that there's two possible explanations for why the drop was so much, because I do think the drop was a little overdone, frankly. But there's two reasons. One is Newmont, being the largest gold mining company, obviously attracts a lot of generalist investors. We've only just in the last month or two seen generalists start to come back to the gold sector. And I can well imagine a generalist who bought Goldcorp in 2011 and lost, 60% of his money, Then he buys Newmont, and immediately after he buys it, they announce their costs are higher than expected and reducing the guidance. And this guy says, enough, I'm done with Newmont. I can see that. I suspect also there was some, algorithms in there. And when you see a headline on costs up, the algorithms sell immediately without asking questions. But again, it's not my favorite of the big cap miners. And even after this drop, I think you might get a trade out of it. But I wouldn't buy it as a longer term investment, frankly, even at this point.
Okay. Yeah, in the rule classroom, we were talking about running a quick option on it to the upside, and that was kind of our thought, is it maybe a quick trade? Yeah. Okay. All right. Okay. Listener.
Oh, no, and one other point on that, if I may. We should see a bounce. I mean, just because you always see a bounce after something has an exaggerated decline. The other thing to remember is that Newmont has a massive buyback program in place. So last quarter, they bought back $50 million worth of stock, and they have $200 million worth on that they renewed their buyback. So if they were buying last quarter, there's absolutely no reason why they're not buying now.
Yeah. Yeah. Okay. Awesome. Alrighty, that handled Robert and Christopher's question. Rafi wants to know, would love to hear Adrian's opinion about the junior royalty space, specifically Metalla and Elemental Altius royalty.
Okay. Well, I like both of those two companies, and we have large positions in the fund in both of them. I don't know if I meant to disclose conflicts as we go along. I guess you can assume that if I'm saying something nice, we own it. Yeah. So in general, the junior royalty space, I think, so junior royalties have a lot of upside potential, obviously. They can be more nimble than the bigger players. They can find meaningful royalties, and most of them only buy legacy royalties or existing royalties. Most of the smaller ones, most of them. They don't go out and create new ones, but they can find these legacy royalties that become meaningful to the smaller company that maybe a Franco or Wheaton or Royal would be prepared to buy, but they don't spend the time and energy looking for them. The problems that the smaller ones have are the competition. There's a lot of competition in the space, and there's always someone that's kind of willing to overpay for whatever reason. There's always someone that says, well, this fits our portfolio. We need a new investment, and they're willing to overpay. And the other thing, of course, is that in the royalty space, bigger really does mean better. The bigger equals better mantra is not one that I generally go along with. But in the royalty space, when a company can be bigger, it can diversify its royalties, which means it reduces its risk. And one of the reasons that we buy royalty companies, of course, royalty and streaming companies, one of the reasons we buy them is because they are lower risk investments. But that lower risk comes both from the business model itself, but also from the diversification of assets. So as they get bigger, they can diversify, they become lower risk. As they become bigger, they have a lower cost of capital. And so becoming bigger is very important. So maybe enough on the space, unless you have another question, and that's one of the reasons that we're seeing constant talks between the various juniors as to trying to get together, merge or take over or so on in order to become bigger. Metalla specifically, if you look at Metalla, it trades at a very, very high multiple on its revenue, cash flow, and other cash multiple metrics, but a very low multiple on its NAV. And the reason for that is they don't have an awful lot of immediate cash flow, but they have some very, very strong longer dated assets, particularly the copper assets that they acquired when they took over Nova, if you remember, which wasn't affiliated, not in a legal sense, but affiliated company.
Yeah, it was the same guys. Yeah.
Yeah, same guys. They founded it and so on. And they took that over, and the market was not necessarily overwhelmingly happy with that, I think it's fair to say, but they did acquire some very, very good royalties on longer dated assets, so like Taka Taka and some of the other big copper projects they have that may not come up on stream until early 2030s or even mid 2030s. But in terms of their NAV, they're very, very cheap. They're probably selling at only about 50% of their NAV. Now, what that means, of course, is that as time goes on, more and more of their assets are going to start producing, and the timeline from now until some of these bigger royalties come on stream gets shorter and shorter. I think you're going to see Metalla, everything else being equal, but it's going to, inevitably just become more valuable as time goes on. And you've seen a huge jump in the stock price recently as they've announced a couple of royalties that are coming on stream. Elemental, really strong people. Again, like Altius, strong people. They've got some good royalties as well. Caserones is one, Carla Winder's another one. Their biggest plus is also their biggest negative, I think, and that is that they have one big shareholder, La Mancha, that owns around 30% of the company. And so that has meant for the last 6-9 months, there's been some upheaval at La Mancha. They've replaced a La Mancha person on their board. The person that's looking at the royalty investments has been changed. And I think that's led to a little bit of concern. It's led to, how can I put this? It's led to a little bit of concern both at the company itself. What can we do? Will they support us? Won't they support us? It's also led to concern in the market. It's interesting to note that in the last deal that Elemental did when they purchased they purchased the second half of a package of royalties that they own half and someone else owned the other half. They bought that other 50%, Allied owned the other 50%. They bought that in shares and cash, but it's interesting to note that La Mancha insisted on exercising their rights to maintain their percentage ownership. So I think maybe they're coming back on board. I don't know. But I like both of them, and I think at today's prices, they're not screaming buys, but they're certainly good buys at today's prices.
Okay.
I'm talking too much, aren't I? Sorry.
No. This is great. Just to summarize here, basically with the royalty space, you like it because they have so many. It's not like Silvercrest where they just have one deposit and they're well, I guess not now with the merger with.
Yeah, that's not the best example.
Yeah, it's not now, especially with Core, but they got many different ones. You like Metalla. It's got a low NAV right now, but in the pipeline, they've got some serious cash flow coming.
Well, yeah, they own a royalty on Gosselin, the Cote Gosselin. They don't own much of the Cote deposit. I am Gold's new mine in Canada. They don't own much on the Cote deposit, but they have a significant royalty on the Gosselin, which is part of the same mine. Probably most of that won't come into production probably for a couple of years yet, but the mine itself is in production, so we know it's moving forward. So things like that are very, very significant for Metalla.
Okay, and then with Elemental, a blessing and a curse is that one fund owns 30% of it, which can be great or awful if he decides he doesn't want it anymore.
Right.
Okay. All righty. Gene wants to know, any thoughts on B2 Gold and EMX?
Yeah. Well, I think B2, let's start with B2 because they're completely different companies, obviously. You know, B2, I think, is a very, very strong buy right now. You know, B2 stock price over the last 12 months was hurt significantly for two reasons. One was Mali, you know, we talked about Mali earlier, but their biggest mine for cola is in Mali. And when you had those, you know, when you had all the fuss in Mali about wanting a larger take, and then you had the press reports saying nationalization. Since it's their largest mine, this really hurt B2 a lot. The second thing that hurt them was cost overruns on building Goose Bay. And that was a big hit for the company because B2 and its predecessor Bema Gold, which is the same team, they have a track record of building mines in difficult jurisdictions on time and on budget. They've had that reputation for 30 years. And Goose Bay, which is difficult jurisdiction, not in the sense of political risk, but in the sense of it's in the Arctic, it's in Nunavut, so it's a difficult jurisdiction to build a mine. That really hurt them. It hurt their reputation. Both of those things, I think, have been solved. First of all, they've got an agreement with the Mali government. They have to increase the amount that they give to the Mali government. But the good news is that it's settled. That's always good. But the second good news is by reaching a settlement, they're now prepared to do. They've got a lot of regional deposits around Fekola, where the mill is already built. And now they're able to go and mine that ore and just truck it into the into the mill. And also it releases them or frees them, if you like, to do regional exploration. And they think there's a lot of potential there. So again, it's like they're getting a smaller piece of now a bigger pie. So that's a positive. And on Goose Bay, we don't need to go into it, but there are, I think B2 has, what shall I say, a defense or excuse for why the cost went over. They were relying on the predecessors. Feasibility, because up there you only have a very small window during the year when you can do certain work. And the truth is that they just relied on what they had been told in order to get in construction during last year. And it turned out to be erroneous.
Fugazi.
So now they put out a new timeline, a new cost. So I think that I have no reason to think that B2 will not meet this new guideline that they put out. Strong balance sheet, very high dividend, of course, which they've said they might cut the dividend if need be to complete Goose Bay. Might. I don't think they're going to, but they might. But yeah, super strong company. I would definitely buy it. You know, EMX is an interesting company. I've said publicly, so I don't mind saying it, but I just think their costs are too high. Both their prospect generation costs and their G&A, frankly, and their G&A, including salaries and bonuses, I think are too high. Now, I understand fully that their prospect generator costs are high because they include those costs in their expenses. And they have more prospect generator costs than many of the other, you know, similar type of companies, other royalty companies. So I understand all of that, but I just think that they need to really control those costs significantly. When a company doubles its revenue and still doesn't make actual profit, you know, there's something that's telling you something, let's put it that way. Now, having said that, you know, they have that royalty on Timok, And Timok had a very, very strong last quarter. Much, I mean, not just the last quarter, but the first half was really quite a strong first half. And then Zijin, the Chinese company that owns Timok, has announced a new discovery at something called the MG zone, which is on EMX's royalty ground. Now we can't, it's early days. We can't be sure that that's going to be successful and be mined, but it's certainly very, very prospective. And no doubt they will, lots of drilling there, we know that. And as I've said before, as I said with regard to Anglo Gold and that drilling to the west of Silicon, you don't do that much drilling if you're not finding anything. So they should update that on their year-end report, and that could be quite attractive for AMX.
Okay, all right. So you like B2 Gold minus the two things that you said that got past Mali, and then with Goose Bay, but it looks.
Well, I think they've solved it now, which means it is a time to buy it, I think.
Yeah. Okay. And then with EMX, same thing. We saw high G&A, high prospect generator costs, but there's some catalysts in the on the horizon.
Yeah.
Okay. Well, talking about prospect generators, Ivania says, Adrian, are you willing to talk about some of the prospect generators that you own?
Yeah. I think in some ways, what we'll call the pure prospect generator companies have been disappointing. And, we've got to remember that whether you're a prospect, we understand the theory of a prospect generator, that by using other people's money, it enables you to minimize risk, minimize dilution. If you're using other people's money, you don't have to keep issuing shares. And by bringing in other people on a project, it enables you to spread your risk, but also go out and find more projects and do the same thing. So I've likened it to having a little piece of several lottery tickets instead of just one lottery ticket. Unfortunately, there's two offsetting factors. One is that these companies, if you look at the history, have actually not managed to avoid dilution. And, we can give examples of companies where, over 5 years, 10 years, it's gone from a 20 million shares outstanding to 200 million shares outstanding. That's huge dilution over a 10-year period. And it's sort of mitigated in the benefit of the model. The other factor, of course, is that whether you're exploring one project or other people are spending money exploring 20 projects, you've still got to have a discovery. At the end of the day, you've got to have a discovery. And some of these companies, even though they work hard, they're doing good work, finding projects, farming them out, they just simply haven't had, the big discovery yet. Yeah. So, I'm perhaps focusing a little bit more on, there's a subsector, if you like, that's called royalty generation. So companies like Orogen, for example, which will stake projects, but they will Orogen in particular, will tend to sell the whole project in return for some cash payments, which mitigate the share dilution, and for a larger royalty, which means they're building building a portfolio of royalties, as opposed to building a portfolio of minority interests in projects, which are normally converted to royalties in the end anyway. So I don't know if that helps or not. If there's specific companies, I'm happy to talk about them. but generally as a model, I think that not, they've not necessarily lived up to the theory.
Okay. Yeah, you and I talked briefly before about like Mundoro, and we're essentially waiting on BHP to hit that drill hole. And until then, it's kind of like a lottery ticket, right?
Right. Well, Mundaro's one we like, and then yeah. So I mean, there's a sort of hybrid, because as I say, they have minority interest, but they're converting them to royalties. Yeah, Mundoro I like, because Mundoro not only has a good balance sheet, but also has positive, it has free cash flow. And I think because it has the free cash flow, that mitigates against having to raise money. It's the equity dilution that really kills these companies. Because, if I buy a company when there's only 10 million shares out, and the company does well and the market cap of the company goes up, but there's now 100 million shares up, my individual shares have actually gone down, even though the market cap of the company's gone up. So if you have a company like Mundoro, perfect example, it's got free cash flow, so it doesn't have to raise money. In fact, I would say that Mundoro doesn't have to raise money to fulfill, their business plan for the next many, many, many years, even if they don't have a discovery. So unless they find something that they want to buy or something, they simply don't have to raise money. So you can afford to be much more patient with a stock like Mundoro, and you have to be patient with these small cap companies, but you can afford to be more patient, because it's unlikely that anything will, as it were, go wrong and cause the stock price to go down meaningfully. You still need the discovery, though. And the other thing about prospect generators is, of course, but you're dependent upon someone else to decide when to drill, how much money to put in, how much work to do before they drill. And even at that, at the end of it, they may decide to back out of it, as Vale did with Mundoro, not because they weren't getting good results, but because of a reorganization of Vale. And so that's sort of frustrating. You're just sitting there while other people are controlling your destiny.
Yeah, one neat thing about that, though, I asked Teo about that, and she's like, "Well, we kept all the information that Vale drilled for us, so."
No, absolutely. And it's funny you say that, because I know when I had a meeting with Teo right after that was announced, and she came in with a big grin on her face, and I said, "You look happy. Why are you happy?" She said, "Well, we got all these great projects back." But that only goes so far, right?
Yeah, true, true. Okay, Krissa wants to know, can you please ask Adrian his thoughts on Osisko development?
Yeah. Well, that's an interesting one. And if I may, I will answer it. So we own a big position. We own a lot of Osisko gold. That's one of our largest, Osisko gold royalties. That's one of our largest positions. And Osisko gold, as you know, owns about 30%. I'm going to look it up. 30% of Osisko development. Let me get the number right. Yeah, 32%. With royalties, of course, right? So my general theme is that if I own a lot of a royalty or streaming company, I'm not going to double up my risk as well as my potential by buying the things that they own a lot of. So sure, if Osisko development has some wonderful, spectacular success, owning the shares in Osisko development will reward you better. But I'm going to be rewarded through Osisko gold royalties if they have if they do well anyway. So I tend not to buy companies where we own royalties or streams on it. And in this case, not just a royalty or stream, but 32% of the shares anyway. Does that make sense?
Yeah,
So I'm
yeah,
not
you're
really
gonna
answering the
get a third of
question
it.
on OD or ODV. You know, I mean, Sean, just as another general thing, I think Sean Rusin was in the wrong, he was the wrong man for the wrong spot at Osisko Gold Royalties. That's not his nature. He's in the right place at Osisko Development, where he can go out, raise money, drill, explore, drill, and build something. That's his skill set. So I mean, I think it's good for both parties, but we already own it through something else, you know.
Yeah. Okay. All righty. Amp has a question. I'm going to share my screen here and I will walk through this just a little bit. Okay. So basically, what he's asking, he says, wondering his thoughts on precious metals and miners when the stock market tops out again. Will they be like in October 2007 when the S&P 500 topped, but metals and miners continued to go up until mid-March in 2008 before they corrected? So basically, this is 2007 right here. This is October 11th, and this bar chart right here is the S&P 500, and this yellow line chart is gold. And so we can see that the S&P 500 topped out as the great financial crisis was just beginning, and it initially had this rundown of 20%. But meanwhile, now this is just the spot price of gold. I didn't do this for the miners, but I would assume it was even better. Gold went up 35% in this. If we are at a topping pattern here in the S&P 500, maybe it goes a little more, maybe this is it, I don't know. But if we are in a topping pattern, do you see kind of a repeat where maybe gold has an initial run up and then the correction when the margin clerk has to do his thing, or what are your thoughts when you see this?
No, that's interesting. If I'm correct, I believe that the XAU actually topped out in August of 2008. So the XAU actually topped out before the S&P in 2008. Yeah, I mean, generally speaking, if you see a sharp drop in the gold in the S&P in the broad market, typically when you see a sharp drop, you see gold sell off initially because, as you say, because of the margins, because of people looking for liquidity, and gold, of course, is the ultimate source of liquidity. You can sell any amount you want 24 hours a day. So gold often will drop significantly at the beginning of the S&P if the S&P drops a lot, and the gold stocks will typically drop a lot too. In this case, the gold stocks topped out before the S&P. But what's really interesting to note is you don't have the XAU up, but the XAU also bottomed well before the S&P bottomed. So if I remember correctly, the XAU bottomed in October of 2008, which is when the S&P was still in mid decline, and the XAU had gone up by 50% by March, which was when the S&P bottomed. So the gold stocks recovered. So the point I'm making is the gold stocks recovered much sooner than the S&P did. And that beginning move with the gold stocks is often very, very dynamic, very sharp. Whether the gold stocks decline and this is coming more to not history, but to the future, whether the gold stocks decline when the broad market tops, it sometimes does, sometimes they do, and sometimes they don't. And what really determines whether they drop or not is whether they participated in the previous bull market. And in this case, it's a little bit of a question mark, because certainly the gold stocks have done very well over the last, this year.
Yeah.
The gold stocks are up, 30% or more this year, outperforming the S&P. But if you look at the long S&P bull market, the 2-year and the 5-year bull market, you'd have to say the gold stocks didn't participate. The valuations also are one of the factors, and the gold stocks right now are still very, very undervalued. and they're certainly undervalued relative to the S&P, where the multiples are very high. So I think if we had a sharp, and this is the third factor, whether you have a sharp drop or a slow rotation. If you have a sharp drop, I think it's unrealistic to think that the gold stocks would not go down with the broad market. That's unrealistic. I think they would go down. They might even go down more than the broad market in the first week, 2 or 3 weeks. But they would probably, if history is a guide, and as the SEC says, past performance is no predictor of future outcomes. But as Winston Churchill said, probably a good way to bet. So, but I did do the SEC disclosures, so they can't attack me for that. If history is a guide, the gold stocks will probably recover much sooner than the broad market.
Okay. All right. So they could have a a run up. If it's a sharp decline, basically, you see the gold stocks coming down. But if past is prologue, they'll recover first before the S&P even hits its bottom.
And if it's a slower grinding sort of rotation type of thing out of the big tech stocks into the more small cap stocks, the value stocks, the commodity stocks that didn't really participate in this long bull market we had, then I don't think you necessarily need to get a drop at all. It just depends on the kind of decline you see.
Okay. Yeah, whether it's a slow grind or all at once.
Yeah.
Whether the margin clerk gets called or not.
Exactly.
Okay. Alrighty. Last listener questions here. He says, okay, now he lists a whole bunch of companies. Maybe you can just kind of give some general thoughts here. Cartier, Canadian Gold Corp, Tectonic Metals, Starcore, Vulcan, Riverside, and Kraken.
Okay, I'm not overly familiar with many of those other than Riverside. I'll make a couple of points. One is these are very small cap companies. I don't think a person should buy a small cap company, a very small cap, a micro cap company, unless they really know the company very, very well. I mean, you can buy Agnico because you're bullish on gold, but if you buy, Kraken or Cartier, you really need to know what's going on there. Kraken is I just looked it up, is a 3.3 million Canadian market cap. So that's less than 3 million US. So that's the first thought I'd make. The second and frankly, with the fund, we are buying far fewer of very small cap companies than I used to buy, just because of there's liquidity restrictions. The SEC has liquidity restrictions for funds, and we simply can't buy many of the small cap companies. The second thing I would say is that some of those companies mentioned, not all of them, but several of them, are probably going to see some tax loss selling this year. So, and I just mentioned Kraken, right? So not to pick on Kraken, but, Kraken would be a good example where the stock price today is basically at its 52-week low. It's just been a long straight line down. So you're going to see some tax loss selling before the end of the year. And the other factor, we talked about share dilution earlier with prospect generators. Unfortunately, when companies are just so small and they're early stage and their exploration, they don't have a lot of ways of getting capital other than by issuing shares. They can't go to the bank and get a line of credit. No one's going to give a line of credit to a 3 million market cap company. Yeah. So they have to issue shares. And again, I'm not picking on Kraken, but I looked it up. Their shares outstanding in 5 years have gone from 7 million to 60 million. So again, I don't know Kraken at all, so I'm not picking on it. Maybe they're doing really stellar work. Maybe everything's going well at the company. I doubt it, looking at the stock chart. But even if it is, when you go from 7 million to 60 million, you know, the share price goes down. And so, yeah, I mean, Riverside is one that I do know. John Mark Stoudy, you know, is a very hard worker. He's got some success. It's unfortunate that they were focused on Mexico when, you know, sentiment towards Mexico started to turn. They do have a couple of projects that I think, you know, could, but a perspective. One is in Sonora, and I'm sorry, I didn't look it up. I forget the name of it now. I'm really sorry. It's a project in Sonora. I've actually been there and looked at it, but Fortuna is earning into it right now. And you know, Fortuna is going to spend a lot of money. They're going to, you know, do the work reasonably aggressively. Aggressive is probably the wrong word, but what I should say is they're not going to sit on their joint venture for the next 10 years. They're going to, you know, give it a shot, put the money in, put the drills in, and so, you know, there could be something. There could be something there. But yeah.
Okay.
And
Awesome.
they've got a good balance sheet, Riverside, whereas a lot of those companies you mentioned don't have strong balance sheets.
Yeah, I need to have John on the show. I think that would be a good interview. Okay, wrapping up here, we're both going to be out at the New Orleans Investment Conference. So I'm looking forward to that. This is going to be my fourth conference, not in New Orleans, but I mean total. So what, do you have any advice for a newbie going to this one?
Yeah, well, first of all, definitely go. I think it's a fabulous show. You know, they always used to have some kind of keynote outside of the investment business. I remember when they had Margaret Thatcher, for example. She was a genuine crowd pleaser. This year, you won't see many of those people, but what you will see is a lot of very, very sharp investment people. I'll say, for example, Brent Johnson, really Santiago Capital. You know, people that are really worth listening to. Jim Bianco, Jim, I can never say his name properly because it's all vowels, Iorio. But these are smart people, and their names are not necessarily, for some of them, as well known as perhaps they should be. So I definitely think this is a conference worth going to. It's over 4.5 days, so it's a long commitment. But it's genuinely worth going to. And the other great thing is that all these speakers, most of them anyway, are readily accessible. You know, if like me, you go on Wednesday, you come back on Sunday, you're there the whole time. There's plenty of time to just you know, talk to speakers, pick people's brains, and frankly, the attendees. Most of the attendees who go are people who've been going, you know, for 10, 20, 30, or, you know, even 50 years. And so these are people who are successful in their own right, who have a wealth of experience in their own right. And just talking to the people at the breaks and the receptions, and of course the receptions, the quality of the food at a New Orleans hotel reception is noticeably better than at many of the rubber chicken dinners that you and I have both been to. So yeah, I think it's well worth going if you can, and spending the whole time there.
Awesome. Okay. Yeah. Brian set us up with a little, we'll be on Media Row. So hopefully,
Great.
you can swing by and we'll do a quick interview. That would be fun.
I'd love to. Yeah.
Yeah. Okay. There'll be a link down in the show notes if anyone watching wants to join us. Adrian, thank you for coming on the show. If people want to follow you and your work, how can they do so?
Yeah, a good place would be adrianday.com. I have a newsletter, which is a separate business from the money management, but that's the best place, adrianday.com.
Okay. We will put a link down in the notes. Adrian, thank you very much for coming on the show. You have a great rest of the day.
Well, thank you very much for having me. Thank you.
Yes. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.